It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Managing Your Financial Future. Welcome back. Another podcast. Johnny Dean, your host, your non-advisor type host, and here with the advisor type, Professor Rick Plum. Welcome back, sir. I don't know why I'm saying welcome back. You never actually went away, but I feel like because these are our summer block. This is our summer season, so people are away, and it seems like nobody big is around right now. They're all taking time off.
The office is a little sparse, even though we've been able to open up a little bit.
It is.
It feels like about a year ago.
It really does, doesn't it?
Not a lot of people here today.
It's incredible. Number of people going on vacation simply because they can.
Yes.
is really astounding. So we've got a kind of skeleton staff here right now for the podcast.
In the office, everybody's working, but most people are working. We do have people on vacation. But
I'm thinking
all the work is getting done.
Just for our podcast, though.
Oh, okay.
I'm saying for our podcast, we have 2 people who normally do the post-production work out. So we're actually recording this like 3 weeks before it's going to go out on the air. But that's okay. That's what we do. We're getting ahead of ourselves. And one of the things I've been trying to look at, I've been kind of collecting questions from not necessarily new questions from people, well, a couple of them. And I wanted to talk about this topic that is very important to us as not just the Lucia Capital Group as a firm, because it's something that they do all the time, but to retirees in general. And it has to do with buckets. And we're going to lead into it by reading a question here, or just a quick question. In fact, it's only 4 words, and that is, should retirees own stocks? Now, I think back years and years ago to my own grandparents who just didn't like stocks. They put everything in bonds or whatever was big back at the time in the 60s and 70s. And
that was back when bonds actually paid a little bit of interest, too.
They paid a decent amount of interest.
And I would probably guess that your grandparents may have had stocks, but a different type. They had a preferred stock, utility stocks, which were kind of a different animal back then than they are today.
That's exactly what they had. I didn't ask what kind, but they did talk about, well, I get dividends off of this stock.
Okay, then they had most likely utility stocks or preferred stocks of the era, the 60s, 50s, in that area.
Yeah, so they didn't like the idea of these growth companies and non-dividend paying, and so that was...
They didn't like the idea of seeing the values go down from time to time.
They really didn't, and they looked at it as a way to supply income.
Well, and in those days, back in the 60s, you could have a portfolio of stocks that were, they were still stocks, so they'd still go up and down a little bit, but they paid a fairly reasonable dividend. Mm-hmm. You could create an income from a stock and bond portfolio that would create a livable cash flow.
It, as I recall, and I was young, but as I recall, it gave them something. It was the smaller part of their portfolio. They had pensions. Biggest part was pension. My grandfather had this nice union pension, and they had Social Security, of course, and then they had these. Even though they said they didn't like stocks, they had these dividend payers that really...
Back in those days, people didn't see utilities because utilities were heavily regulated and all this, not like they are today.
Yeah.
And they had the preferred... So people didn't see them like stocks. They didn't see them like a growth, roll the dice, the way the volatility that we have today. And back then, people would supplement their pensions and Social Security with these types of investments and bonds, because bonds were paying better than what they're paying now, and they would live comfortably. And so that's the day. And so people now, they're looking back and they're starting to get ready to retire today, and they're saying, well, grandparents did it just fine. Why don't we do it the way they did it? Because those days are gone.
Well, and they look at, we've seen a couple of big drops over the last 12, 13 years. We saw, of course, 2008, and we saw a quick one, but the one we've talked about before, which was in the spring of 2020. So the volatility is what they were concerned about.
It was a fairly sharp decline in 2020, and in March 2020, April 2020, people were starting to get worried, and then all of a sudden, it recovered. They didn't even have time to react in some respects. If it had gone on a little more, you would have seen more people reacting negatively.
You're right. And it was a good reminder of what I think can happen. People say, well, stocks don't go up all the time. I mean, they've kind of continued on that trajectory.
Well, we talk about this 11, 12-year, basically a bull run with a minor hiccup last year, in 2020. And people get, the stock S&P has averaged this and that. Sure, it's done very well. But even during that 11-year run, it wasn't all roses. I mean, there were several times, I think of 5, where we were, it was a bull run the whole time up until, last 2020, last year. But that doesn't mean it was positive the whole time. And there were down periods. I mean, the end of 2018, the last half of 2018, we were down like 19.9%.
It was
as
this
of
close.
Christmas, but it didn't hit the 20% mark. So, and then it recovered, so people forgot about it. We were down better than 15%, more than 5 times in that period of time, in that 10 years, 11-year run, and people forget about that because, on average, the S&P was doing 9%, 10%.
Well, historically too, I think stocks go up more than they go down. I've heard that. I don't have the actual stats in front of me.
Over a year-by-year basis, it's interesting. If you go by a day-by-day, if you look at each calendar year, how many up days versus how many down days, it's like 45, 55%. 55, 45% up, 45% down. You go to years, it gets more like 3 out of 4. You go to 5 years, it's the longer that time horizon goes, the fewer down periods you get. But if you're just going by days, it's in a 6-month period of time, you're going to be closer to almost 50-50.
It could be a crapshoot,
but it keeps going. The longer you go, then they start adding to the positive time.
Well, yeah, and I think you get to a certain number of years. I don't know if it's 25 or 20 or where there's never been a period where
15.
Is it 15?
So far in historical terms, we've never had a 15-year period of time where the market, as measured by the S&P, has been negative.
Over that period of time. Doesn't mean it's not going to happen, of course.
We've had 10-year periods of time that the market has been negative, barely, but it hasn't recovered all the way at 10-year mark.
Well, and this is why people are still asking this question about owning stocks, because if you're going into retirement and obviously you don't want to run out of money, how do you achieve both income to a certain level and growth if you're taking money from a stock portfolio that is bad? Now, that's a question that's down.
You don't necessarily need growth if you have enough income to be able to have enough income to spend and a little bit more income to be able to reinvest so that the overall portfolio continues on an upward trajectory as far as values. It doesn't have to come from capital appreciation, growth. It could come from, if I had a $1 million portfolio and I put it into a 10-year treasury bond paying 1.4%, but I only spent 1%, then my portfolio will grow by that other 0.4% a year.
But you got to live on the 1%.
I got to live on the 1%.
Well, what about somebody? What if somebody says, I just don't like stocks? And maybe you've heard this. I don't like stocks. So I've got, let's just use $1 million. I know $1 million is still a lot of...
It's just easy math.
It's just easy math. So I got $1 million. I'm going to take this $1 million. I'm going to put it all in... I don't know, CDs.
Okay.
And I'm going to, I've heard about this 4%. You can take 4% out. So if I put this in CDs that are paying virtually nothing these days, and I take out 4%, am I going to be hurt by that?
Well, define hurt. It's a matter of, if you are, let's call it 65 years old today, you can take 4% of the initial $1 million, $40,000 a year, and you can get 26, 27 years out of it, even if interest rates don't go up, and you'll get that $40,000 a year of cash flow, not earnings, but cash flow. You're taking principal, majority principal, for 26 years, 27 years. Now, at 27 years, there's going to be very little left, if anything, for your heirs. If you live longer than that, you got nothing left. So there's no wiggle room. There's no inflation adjustment. There's no, but you can make $1 million last for 25 years by putting it in your mattress and pulling $40,000 out a year.
Or any number you want, or half that, 500,000. But of course, you can only pull
4%,
out $20,000 out of that.
The issue is, people will come and say, first off, I want to get my 4 or 5%, and I want to leave my kids the portfolio. at least as much as it is today, hopefully a little bit more, so that they have an inflation-adjusted amount that's kind of similar to so they're receiving my assets today. Okay, that's harder, because now you have to be able to pull money out of the portfolio to live off of, but have enough earnings, however you're going to get those earnings, interest, dividends, growth, whatever the case may be, to replace the amount of money you're taking out. In the original example where we were just, put $1 million in a cabinet, and we're pulling $40,000 packets out every year.
Which is almost like a CD these days.
Yeah, that's not, you're taking mostly principal, so there's not enough earnings to replace what you're pulling out. The idea is most people want to be able to have enough earnings to replace what they're pulling out. So they want to live on interest only. They want to live on the earnings alone. But even that's hard to do in today's world when you've got the 10-year Treasury sitting at about 1.3. You've got a 3-year CD in that 0.7, 0.8% year range.
Yeah.
You've got the average dividend on like the S&P, just under 2%. So where are you going to cash flow? Where are you going to create cash flow that's not coming from principal, that is in that 4 or 5% range? You could use other things, real estate and some other things, but now you've got different issues. You've got
different risks,
lack of liquidity. You've got what some people consider to be a fairly high entry point at the moment.
Mm-hmm. Yeah, maybe very high.
Of course, if we look a year or two down the line, this may not be a high entry point, or this may have been the peak. I don't know.
But see, there's your volatility that you want to that some people don't like. So what you're saying is having some stock portfolio with the potential for growth is maybe one of the few choices you have left.
You have to find a way to be able to, if you want the portfolio to last and stay within value of where you started from, you got to have some growth in it somewhere, somehow. Now, the problem with growth is, as you've mentioned, volatility and unpredictable, impossible to predict volatility. Nobody has ever done it so far, be able to predict when the high of the market is. We've never been able to find a system, a person, a soothsayer, a psychic, anybody who can tell you when to get in and when to get out with any degree of accuracy going forward. There are too many things that affect the market, and a lot of things that affect the market that cannot even be comprehended at the moment. You go back 2 years from now, or two years from today, and you say, in 6 months, there's going to be an issue that's going to drop the market 34% in 33 days. And what's it going to be? It's going to be a pandemic.
I never saw any of that predicted.
Never heard of that at all.
Didn't occur to us. Well, so what these people are looking for, what somebody is ideally looking for, is the have your cake and eat it too sort of thing. It's like having you want to prune your roses off of your rose bush, but you don't want to prune it all the way to the ground. So how do you trim off enough for you to enjoy what you have, and yet have it still there by the time you're gone, or by the time you've reached age 90 or whatever it is? How do you take it out and still have it left over?
Well, and that's why we do buckets.
That's where buckets comes in. So let's talk about that. Explain how this works for people who don't understand.
Well, one of the things that we try to avoid in investing, the old adage, how do you make money in the stock market? You buy low and sell high. Unfortunately, the average investor doesn't do that. They buy high and sell low because they get emotional, they make all kinds of bad decisions. But how do we get growth and not ever put ourselves in a position where we either have to not spend money because the market's down, or we have to sell something in the market when it's down? Well, the only way to do that is to have enough rainy day money, sitting on the sidelines that we can draw from in those times when the markets go down. Now, when the markets are going up, life is rosy. The market, last year, over the entire year, if all you're looking at is year over year, was up, 25, 30%? It was up.
2020?
Yeah, 2020 was huge.
Volatile, but yeah.
So how do we avoid having to sell in March of 2020 if our portfolio is in something that has volatility? Even a balanced portfolio, it's 60-40, 50-50 stock bond mix, however it works, they have volatility as well. So one of the key issues when you're creating a portfolio that's designed to give a distribution of money so you can spend and live, one of the key issues, you never want to be in a position where you sell something when it's down. And we're talking about a portfolio, not an individual stock. There are times where, you've got a stock that you've got to cull because, the FDA came out and said that pharmaceutical, that's not going to work.
Yeah, those
that's
are
an individual. We're talking about a
twosies,
diversified portfolio. So how do you avoid selling when the market may be down? When you can't predict when the market's going to be down, you have to have enough money on the sidelines that you can draw down. So the big debate is, how much safe money do we have?
When you say safe, you mean money that's
not volatile.
Not volatile. Okay, something
that's
got
liquid.
Some guarantees and is liquid.
Yeah, or very low volatility. We can, depending upon your definition. And I remember I was speaking in front of a crowd talking about this topic a couple years back, and the gentleman said, "Well, what if I have a year's worth of money in my bank? I need to spend $40,000 a year, and I've got $40,000 in cash that I can draw my $33 a month from." Well, that's a start, but historically speaking, how long is a normal downturn? Forget 2020's downturn. That was not historically normal. Now, maybe that has become the norm going forward. We don't know yet, but historically, the average downturn in the market is about a year and a half. Now, that's from the high to the low.
From the high to the low? Okay.
Not from the high to the low to the high.
That's just from
that's
the
from
top.
the high to the low.
Yeah.
So a year is a good start, but all that did was put you in a position where you were selling closer to the bottom to be able to replenish.
Selling low again.
And so the average time from high to low back to high or back to even is more in the 6-year range, 7-year range.
Wow, is it that long?
It usually takes some time. Even in 2007, When did we get back to even after the high of 2007? It probably wasn't until 2013, maybe. I can't remember. I'd have to go back and look.
Yeah,
we had some nice gains. Most of it coming in 2009, right after the down, the bottom.
But that was just to get back to where we were.
Just back to even.
Yeah.
And so we're looking at different time horizons. If you go all the way back to like the 1972-73 downturn, which was a big downturn, it was down like 45% over those 2 years. It took 12.8 years to get back just to what T-bills were earning. Now T-bills were earning nice back then, but it's still, how do we avoid selling in a downturn? So we have to have enough money on the sides.
When you say money on the side, some people think, well, just an emergency fund. Let's take our example of our $1 million person, and we
want $40,000 a year.
We want $40,000 a year, and we're not going to now put it all in CDs because there's a chance that this person may not.
If I can avoid spending some of the money for 15, 20 years, why would I keep it in a CD?
Yeah, why would you keep money safe if you don't need to spend it for a long time? So
if I can avoid selling when it's down, why would I want to worry about getting a 0.5%, 0.8% rate of return?
So what would you do with this person's $1 million? This is just a random person. Obviously, this is general information.
Very general.
Everybody's situation is different. But what would you do?
You want $40,000 a year. I want to have enough money in to be able to live for, the bad downturns. So I want to put. If I want $40,000 a year for 7 years, assuming it earns nothing, we can just do easy math here. That's $280,000. Take 28% of my portfolio, put it in CDs.
So I've now got, theoretically, 7 years of non-volatile or low volatility money that I can count on. It's liquid, and I have that for the next 7 years. It's not going to earn anything in our example, but it's going to be there when I need it, and I can draw from that over the next 7 years when...
Drawing it down, principal and minor amount of interest.
But most principal.
Mostly principal over the next 7 years if the market goes into a tailspin day one.
Which...
Hey, Murphy's Law says the day you invest, it's going to happen.
So you don't just... now, I've got this 7 years of non-volatile money. Am I going to just live off of this for the next 7 years?
Yeah. You don't have to. If the market goes up 25, 30%, you can always pull from the market. But you have this money available to you if the market's being volatile. Oh, my goodness. Is the market volatile? Is it ever volatile? Yeah. So and now the reality is you would probably do something besides putting all of that into a CD. you would try to get a little bit better rate of return, even over the short term, maybe ladder out some bonds or do some
maybe
other
a
things.
CD or money market for the first year
or two or three, and then do a 3-year bond, a 5-year
so
bond.
it'll give you something besides
something to
0%.
get a little bit better rate of return.
Okay.
But let's just take it extremes. We just put it in the bank, $280,000.
So I have $280,000.
Now that only lasts for 7 years, though.
Yeah. So I've got another.
And if I want to make sure that I have time for the market to go through its bad days, like 2000 to 2010, heck, that didn't even get the market back to even.
So I need more than 7 years.
But it doesn't have to be perfectly liquid. It doesn't have to be completely non-volatile. I can accept a little risk with a 7-year time horizon. That's where we can use more of a balanced portfolio or some of these other structured capital products or things where they have some downside protection, but still give us, we're not going to get 8, 10, 12% rates of return because we're only dealing with a 6-7-year time horizon. But if you look at like a balanced portfolio, in 2007 to 2009, the average balanced portfolio was down like 25%, about half as much as the market. But it also recovered back to and made a positive return within 5 or 6 years. So we were back to a positive return when the money was necessary 5-6 years later.
So I've got my 7 years that I've set. So for years 8 through
15, 8 through 16,
I've got another chunk of money,
right, that I can use to replenish bucket number one when it's gone down. But because it doesn't have to be as liquid, because it doesn't have to be as non-volatile, it can be mildly volatile, I can get a little bit better rate of return.
A little higher on the risk scale, but a little higher on the return.
But not all the way rolling the dice, not all the way pure stock market.
How much would you put in? I've got, what do I have? About 720,000 left of my million.
Well, let's just, let's say, let's put another 280 there, because it can get a little bit of an inflation bump after 7 years.
Okay,
but
so
just for easy math.
So another 280,000 for
we've
years.
Used 560
for years 8 through 15.
Right. So now we have to be more than 280. Make it 320, because we've got 8 years instead of 7 years.
Okay. Okay.
So we've used 600,000 of the $1 million, but now I have 400, and I've my income need for the first basically 15 years. Very little volatility in the first set. Minor volatility for the first 7 years on the second bucket, no volatility, then it changes to a new bucket number one after that. So I haven't taken very much risk at all to give myself my 40,000, but I've got 400,000 left over that I can now afford to put at the stock market. I can afford to take that risk with it.
Because I don't need the money. This is money that's for 15 years from now.
I've got money to live off of. I have identified that I can afford to take the risk of the pure stock market investment. And if the market goes down tomorrow, who cares?
I don't need this money for a long time.
It's got 14 years to recover after that. Now, and so then we just work off of those kind of things. Over the next year, the market could easily be up 15% or down 15%. But what if it's up 15%? What if it's up 20% like it was in 2020? Well, we can always identify excess profits and use those to replenish what we've taken out of bucket number one.
Which buys us a little more...
Which buys us more time again.
Time of a little more income.
So the whole idea is to understand the risk that you're facing, protect against the risk that you're facing, but also identify when it's better, when things are happening better than expected, and not be outrageously greedy. And take your profits when you have profits over and above what you expect. Now, my expectation on bucket number three, if my expectation was 9% and it's up 10%, probably not going to do a whole lot of movement at that pace. But if it's up 30%, I may say, you know what? The market's just, let's take a little bit of that extra money and pull it off the top. And let's just not be totally greedy. That's a different mindset when you're retired than when you're trying to build your portfolio. When you're 40, 30, even 50, those 30%, you're still staying all in. You're going for the gusto. When you're trying to maintain a portfolio that's creating a stable income, when it's greater than expected, take some profits. And that's the reason we do the time segmented way of doing it. People will say, I just want to live off interest alone. I don't ever want to spend $1 of principal. I don't want to ever have to sell anything ever, principal. Well, you're going to live on 1 or 2% this year because you're not making very much. And if that's okay, I mean, I've met people that have, decent amounts of pensions and things. They really don't need anything from their portfolios. They have kind of a free reign of what they invest in, because if it goes up, fine. If it goes down, they don't care. They got all their money covered elsewhere. We're going to have. Now, the big debate with buckets isn't that we need money on the sidelines for a bucket number one, a moderate bucket, bucket number two, and growth. It's what time horizon are we going to deal with? I've had more aggressive, sophisticated investors say 15 years, we're not going to see that again. I don't want to worry about that again.
Meaning what?
I don't want to have 15 years of income in bucket one and two. Maybe 10.
Because they want more growth?
They want more growth. They want more juice.
Okay.
So they create a bucket one for 5 and a bucket number two for 5 instead of 7 and 8 like we did in our original example. I've also had more conservative retirees say, you know what? I'm 70. I may make it to 90, and I don't want to ever have to worry about it. Make it a 20-year bucket. 10 on 1 and 10 on 2. And so
as in give them 20 full years.
Give them 20 years of bucket one and bucket number two of money.
So that they kind of bought themselves income.
Out to death.
Now, and they're going to be spending principal. And I guess in this example, they would be unlikely. This doesn't sound like something that's going to send your portfolio way up into the stratosphere.
They're more concerned with sleeping at night, not worrying about downturns, not worrying about running out of money in their expected lifetime, and not as worried about leaving the kids richer than they are.
This is a big change from somebody who's, you just mentioned this, 30, and trying to grow their portfolio.
Well, it's actually a lot easier to create and develop an investment portfolio than it is to take an investment portfolio and create a distribution pattern from it. Because when you're young and you're developing a portfolio, or when you're still trying to build the portfolio, the hardest thing you have to do is not the investments, it's finding the money to put into the portfolio.
Well, and that's good for somebody who's 30.
Oh yeah, want to, but you can go all growth. If it goes down, you want it to go down at some point so that you can buy more.
Because
you can buy it on sale. There's a sale at Penny's.
Exactly. Well, that's how we look at it. Very quickly, because we're running out of time. But as you get closer to retire, if you're going to retire at 65, you're 59, 60 years old.
Right.
You've been going with this growth. Should you at this point?
You want to pull back the aggressiveness before you retire. If you're looking to it depends on you, but if you're 60 years old now, you're going to retire at 65, and you're looking at the numbers going forward, now is the time to start paring back and creating at least some of that bucket two, maybe even a little bit of the bucket number one, because you don't want to wait until 65, because what if the market crashes when you're 64?
Going back to Murphy's Law says it will.
Oh yeah, that's just life, isn't it?
Yeah.
And where you're saying, okay, if I do this and I project out, I'm going to have my $1 million by 65, whatever number it is you think you need to retire, and you're on target, you're actually a little above it, and you're thinking, I can even golf more than once a week or whatever it is you're trying to do. And then when you're 64 and you're starting to plan your retirement party a year out, the market craters by 35%, and your $1 million turns into 650. Oh man. Now
there goes my retirement party.
I got to work a couple more years while it recovers.
So the idea is to do it before.
You want to do it far enough, 5 to 10 years ahead of time.
And so you change it from aggressive to, you don't want to back it off completely.
Well, no, you go through and you start bucketizing. How much money am I going to need? When am I going to need it? Where should I be putting
So
it?
you should be doing this. If you're going to retire at 65, maybe start doing this around 60?
Yeah, maybe even 55, depending upon your aggressive nature or conservative nature. Mm-hmm. But the difference is, okay, when we're talking about taking some money and moving it to, bucket one or bucket two, the less volatile areas, some people say, well, I'm just going to redirect my 401k to create my bucket number one. I'm saving $26,000 a year in my 401k, and over the next 5 years, I'll save, $125,000, $130,000, $140,000. I don't want to use my ongoing savings to create bucket number one that has very little volatility. I'll use existing money and put it into bucket number one and sit it there. And I'll continue to put my 401k contribution, my IRA contribution, my ongoing dollar cost averaging, systematic investing into the stock market. That gives me the advantage of that dollar cost averaging. That money is not the money I'm going to spend right at retirement, bucket number one. I've got that set. That money is I'm going to spend 15, 20 years from now. So I want that time horizon working for me. I want that volatility working for me. So you won't have the same contribution percentage into the same funds as your overall portfolio once you've started bucketizing.
your 401k, that new money that you're putting in every paycheck, every
month, you go for the
every
dollar
2
cost
weeks,
averaging, you go into the growth.
and you don't put any of that new money into the safer one.
You don't get any advantage from that. I mean, that's just, there's no advantage of ongoing savings into the savings account unless you don't have any savings. You need your emergency fund.
Yeah.
But if you already have bucket number ones, because if you've left the other, $800,000-900,000 still in the portfolio and you're building up this bucket number one, you can't build it up quick enough in the next 5 years. And if the market goes down by 35% like it did in March of last year, your portfolio still went back down to $600,000. That's still not helping you at all. That's when you want to be buying into the equities. So you want to use the volatility to your advantage, dollar cost average into volatile assets. 401k contributions are by definition dollar cost averaging.
That's what it's one of the wonderful things. Besides the set it and forget it nature, where you don't even see the money,
too.
And you look after a year or two, you say, "Wow, I've saved a decent amount. Who knew?" If you want to know more about this stuff, we talk buckets, we talk retirement, we talk distribution strategy, which I really like, Professor, because so many times. You see advertisements for people who say, we're going to get you to your retirement number. Is it $1 million? Is it $500,000? Is it $2 million? Is it whatever? We're going to get you there. And once you get there, you're left holding the bag. And what do I do now? How do I take money out?
Or worse, they just continue the same type of strategy, but instead of putting money into the portfolio, they turn around and take money out of the portfolyo on a reverse dollar cost averaging aspect coming out,
which can be
disastrous.
As you've said, it can be disastrous. So this is why you need to have a strategy. You need to have a plan. We talk about buckets. Buckets is the one that we prefer. We believe it needs to be done correctly. We've seen it done not so correctly.
Oh, there are books that I've seen and some of the websites that are very well respected talk about 1 and 2 years in bucket number one.
No. Historically, we've seen that's not going to work. If you want to talk more about this, you can talk to Professor Plum, any of the Lucia Capital Group advisors about this stuff. 800-644-1150, 800-644-1150, or go to luciacap.com. You can find a lot of answers there. We have a lot of articles on buckets. We have other podcasts there, and you could check out some of our Lucia Capital Group weekly features. All this stuff, if you want to learn more, luciacap.com, luciacap.com, or as I said, just give them a call. 800-644-1150. You want to know more? You want to get more topics on this podcast? We'd really appreciate it if you'd subscribe. Go to Spotify and you can download the podcast. You can get them downloaded to you, notified when there's a new one. We do one every week. Except for in between seasons, and all kinds of topics. You can learn more about that. Go to Spotify and subscribe. Professor, thank you so much.
You're very welcome, sir.
We got another topic next week that has to do with Social Security. I know we've talked a little bit about this, but we've got some questions on this and some common questions. We'll cover that in next week's podcast. For Professor Rick Plum, our certified financial planner, professional, CFP type, I'm Johnny Dean, your podcast host. Thanks so much for listening. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. There are two types of equity, common stock and preferred stock. Preferred stockholders have a higher claim to dividends or asset distribution than common stockholders. Preferred stocks are sensitive to interest rates. The share price generally falls as prevailing interest rates increase. Other risks include perpetual life or very long maturity, a call feature, low credit standing, deferrable dividend, and, for traditional preferred stocks, depressed yield due to demand from corporations that receive favorable tax treatment. The details of each preferred stock depend on the issue. It is important to keep in mind that investments in fixed income products products are subject to liquidity or market risk, interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Structured products are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. Past performance is no guarantee of future results. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.